Okay, let's unpack this classic investing question. You're looking at your options, maybe starting out, maybe rebalancing, and you hit this fork in the road. Blue chips or growth stocks? Which way do you go?
It's a really common one, that steady hand versus the potential rocket ship.
Exactly. And it can feel like you have to pick a team. So today, in this deep dive, we're aiming to cut through some of that noise. We've got some fantastic sources here that really distill the core of this choice.
Yeah, they give a great perspective.
Our goal is simple. Clarity in markets, confidence in decisions, that's what we want for you. By the end of this, you'll get the fundamental differences, the pros, the cons, and hopefully start seeing how you might think about which strategy, or maybe, a mix, fits your personal investing journey.
Right. It's not always black and white.
And we've got some interesting nuggets coming up, too, like how some of those seemingly boring stocks can quietly be powerhouse performers over time.
Oh, yeah. The compounding effect. It's powerful.
And how even the big tech darlings, well, they change over time, don't they? Their profile shifts.
Absolutely. The market's always evolving. It's easy to get stuck thinking it's just one thing or the other. But understanding both and how they can work together, that's really key for building a solid portfolio.
Okay, perfect place to start then. Let's define the players. Blue chips. Everyone sort of knows the term, but what really makes a company a blue chip? Is it just about being big and around for ages?
Well, size and age are part of it, sure.
Right.
But fundamentally, our sources emphasize a blue chip is a really well-established, financially sound, decades of history behind it.
Okay.
Think names like Coca-Cola, Johnson Johnson, maybe Procter & Gamble. These aren't just big companies. They typically dominate their industries.
Market leaders.
Exactly. They have stable earnings, really strong balance sheets, and crucially, they usually pay regular dividends to their shareholders.
Ah, the dividends. That's
Yeah.
a key piece.
It is. They've proven they can weather economic storms, downturns, you name it. That's why they're often called the sleep well at night stocks. They can form the sort of backbone of a stable portfolio. They're not necessarily exciting every day, but they're reliable.
Okay, so reliable, dividend-paying giants. Got it. Now, let's contrast that with growth stocks. If blue chips are the steady oaks, what are growth stocks? Are they like fast-growing saplings?
That's a good analogy, yeah. Growth stocks are quite different. They might not have that long history yet, but what defines them is rapid growth. We're talking revenues and profits increasing at a really fast pace.
Faster than the average company.
Oh, much faster. Think about companies focused on innovation, capturing new markets. Their whole strategy is usually about reinvesting profits back into the business itself.
So not paying out dividends like the blue chips.
Rarely, if ever. They take that money and pour it back into research, development, expansion, trying to grab more market share. The idea is to grow the company and therefore the stock price as quickly as possible. So they offer this huge potential upside. That's the excitement. But, and this is the catch, that potential comes with more volatility, higher risk.
Right, makes sense. More potential reward, more potential bumps in the road.
Exactly. Think about, say, Apple in its early days, or Amazon, Google, Tesla more recently, constantly pushing, expanding, innovating. That's the growth stock profile.
That paints a really clear contrast, stability versus speed almost. So when we dig into the comparisons based on our sources, what are the key differences investors really need to grasp?
Okay, let's break that down. The first big one is definitely stability versus volatility.
We touched on that.
Right. Blue chips are known for being steadier. They probably won't double your money overnight, but they're also less likely to crash hard when the market gets choppy. They offer a smoother ride.
Which can be very comforting.
Absolutely. Growth stocks, on the other hand, can see really big price swings, up and down. Their value can jump or die based on things like earnings reports, news about competitors, or just general market move swings. It's potentially a much bumpier ride.
Okay, stability versus volatility. What's next?
The second point is dividends versus reinvestment. We talked about this, but it's crucial. Blue chips typically pay out a portion of their profits as dividends.
That regular income.
Yeah, that's steady cash flow. It's attractive for people who need income from their investments, like retirees, for example.
Sure.
Growth stocks. They usually keep that cash. They reinvest it to fuel more growth. So your potential return comes mostly from the stock price going up, not from dividends.
So it's a choice between income now, potentially, versus aiming for bigger capital gains later?
Pretty much.
Yeah.
And that directly ties into the third point, risk versus reward.
The classic trade-off.
Exactly. With blue chips, you generally have lower risk. They're established, stable businesses. But the flip side is usually lower potential for those really massive, explosive returns. It's more about steady, gradual wealth building.
Thanks.
Growth stocks are the opposite. Higher risk, the company might stumble, competition could heat up, the market might sour on them. But if you pick the right one and it succeeds, the potential reward can be huge, life-changing sometimes.
Okay, so risk and reward are closely linked. Is there anything else?
Yeah, the final point is time horizon. Who are these best suited for? Blue chips are often great for investors who, want that peace of mind. They're thinking long-term, maybe decades, and don't want to lose sleep over daily market swings.
The sleep well at night factor again.
Right. Growth stocks, because of their volatility, tend to be better suited for investors who can tolerate more risk and have a longer time horizon. You often need to give them more time, maybe 5, 10 years or more, for their growth story to really play out and ride out the ups and downs.
These aren't just abstract ideas, are they? These choices have real consequences for your money, your stress levels, everything. Let's make it even more concrete with some real-world examples our sources mention.
Definitely. Let's take Coca-Cola. It's like the textbook blue chip. For decades, it's provided those consistent dividends, stable earnings, steady growth. Maybe not flashy, but dependable.
A household name, solid performance.
Exactly. And here's that interesting point. Sometimes these dividend-growing blue chips over very long periods actually deliver total returns that rival or even beat the flashier growth names, especially when you factor in reinvested dividends and lower volatility. It's the quiet power of compounding.
That's counterintuitive for a lot of people, I think. We focus so much on the high-growth stories.
We do. But then you look at a company like Apple. 20 years ago, it was absolutely a growth stock.
Oh, for sure. iPods, iPhones coming out.
Right. Reinvesting everything into innovation, explosive growth.
Yeah.
Investors who got in early and held on saw incredible returns. But look at Apple today.
It's different now, isn't it? It's huge, mature.
Exactly. It's transitioning. It still innovates, of course, but it also pays dividends now. Its growth is moderated. In some ways, it behaves more like a blue chip these days, albeit a very innovative one. It shows how companies can evolve.
That's a great point about evolution. What about another classic blue chip?
Johnson Johnson. Healthcare giant, super reliable reputation, consistent dividends for decades. Diversified across pharmaceuticals, medical devices, consumer health. That diversification helps it stay stable.
Okay. Solid and steady. And for growth, the volatile example.
Our sources point to Tesla. Prime example.
Definitely volatile.
Extremely. Constantly innovating in EVs, batteries, AI, energy, pushing into new areas, scaling up production. The stock price has been, well, a roller coaster, huge swings.
Yeah.
But for those early investors who believed in the long-term vision and could handle that wild ride, the gains have been extraordinary. These examples really highlight the different paths companies take and the different experiences investors have.
It really drives home that these aren't static labels forever.
Okay, so we've seen the definitions, the comparisons, the real-world examples. Let's try to boil this down. What's the clear summary of the pros and cons for each?
Okay, let's summarize. For blue chip stocks, the big pros are stability, those regular dividends we talked about, generally lower risk compared to growth, and reliable performance, especially when things get tough economically.
This is pretty good. What's the downside?
The main cons are usually limited growth potential. You're unlikely to see your investment multiply many times over in a short period. The upside is generally more modest.
Okay, stability over explosive growth. And for growth stocks?
The pros there are the flip side. You get exciting innovation, the potential for really high returns, that massive upside, and the company is aggressively reinvesting to expand and capture the market.
The excitement factor.
And
Cons. Higher volatility is a big one. Those price swings can be hard to stomach. There are generally no dividends, so no income stream there. And there's a greater risk of failure or just fizzling out if the company doesn't live up to those high growth expectations or gets outmaneuvered by competitors.
so high potential, high risk, no free lunch there.
Not usually, no. Understanding these trade-offs is absolutely key before you decide where to put your money. They serve very different roles.
Which brings us right to it. The million-dollar question, maybe literally for some listeners, which one is right for you? How do you make that call?
Well, like we've been saying, it really depends on you. Your personal situation, what are your financial goals, how long do you plan to invest, and maybe most importantly, how much risk are you comfortable taking?
Your risk tolerance.
Exactly. Let's imagine, say, you're younger, just starting your career, you've got decades until retirement. You might feel comfortable taking on more risk for the chance of higher growth. Maybe growth stocks play a bigger role for you then.
Makes sense you have time to recover from downturns.
Right. But now imagine someone nearing retirement. Their main goal might be preserving the capital they've saved and generating some steady income to live on.
Yeah, totally different priority.
For them, blue chip stocks, with their stability and dividends, probably make a lot more sense. It helps them sleep well at night, knowing their income stream is likely secure and their capital isn't exposed to huge swings.
So it really is tailored to the individual. But here's a crucial point our sources bring up. It doesn't have to be strictly one or the other, right?
Exactly. That's perhaps the most important takeaway. You don't have to choose just one camp. In fact, many successful investors build portfolios that strategically include both.
Ah, the blended approach.
Precisely. Think about it. The blue chips can provide that stability, that foundation, maybe some income. They anchor the portfolio.
Okay.
And then the growth stocks can add that potential for higher returns, that bit of excitement, the chance to really boost your overall wealth over the long run. You're getting potentially the best of both worlds.
So it's about finding the right balance for you, combining that stability with that growth potential.
That's often the smartest way to go. Creating a mix that aligns with your specific goals, your timeline, and how comfortable you are with those ups and downs.
Okay, so wrapping this up then. The core message seems clear. The best portfolio isn't about picking blue chip or growth. It's about building one that truly fits you, your goals, your investing timeline, and critically, your personal tolerance for risk.
Absolutely. There's no single right answer for everyone.
But there is a strategy that's right for you.
And maybe a final thought to leave you with, connecting this to the bigger picture. It really invites some self-reflection, doesn't it? What parts of your financial future matter most to you right now? Is it that sleep well at night dependability that the blue chips offer? Or is it the excitement and the huge upside potential from growth stocks that really gets you motivated? And thinking beyond that, how can you maybe blend those? How can you build something that reflects not just your financial needs, but your values too?
That's a great question to ponder, finding that personal balance.
That's the challenge and the opportunity.
Well, thank you for joining us on this deep dive into blue chip versus growth stocks. We genuinely hope these insights help bring you that clarity in markets and boost your confidence in decisions.
I hope it was helpful.
Take these ideas, think about how they apply to your own situation, your own journey. Because ultimately, this knowledge, understanding these differences, it's your shortcut to being a well-informed investor.